It looks like we need to pump up the energy in this room a little bit. Everyone's in post-lunch slumber, so hopefully we can keep this very interactive. I think we've got a terrific panel for you with very different backgrounds and experiences, and we want to make sure we leave enough time for Q&A today to keep this interactive. But, you know, Aditya just read out everyone's bios, but I thought it would be helpful if each of you could give a little bit more perspective and background on why you're doing what you're doing and the unique aspects of your areas of focus. And Rishi, if I may ask you to start off with that, and perhaps we can work down the row.
Sure. Thank you very much. So art clearly is the focus of Aura Art, as we can see. Art globally is a very significant part of the wealth allocation of any HNI, ultra HNI, family office. Clearly, after a particular amount of wealth creation in the economy, investments for passion become very important to the HNI. I will also just sidestep into the entire continuum of asset allocation. If I may just change the slide. Yes, sorry. So alternate assets, and all the colleagues here will be discussing different subjects of it. So as you move from the initial phase of wealth creation to the next level, which is what the threshold India has crossed in the last few years, China crossed 10-15 years back, you see a great amount of focus towards investments for passion, where the HNI, the family starts believing that they want to invest in collectibles, in other assets which have a greater feeling of association for them, a greater involvement on their part, and some part of aesthetic and social status, social messaging value, besides simply the ROI that drives the investor, wealth manager, family office mentality in the early phase of wealth creation, when meeting certain financial goals becomes a priority. So here you've met your financial goals, you've moved beyond that, you've got surplus wealth, and that's when you start seeing as to where I can diversify first beyond traditional assets, as well as do something which I engage with and enjoy. Art then becomes one of the most important themes. Looking at one slide as an example of how family treasure, so to say, is important at different stages of evolution. And this family treasure comprises from gold to heritage furniture to art, other collectibles, sculptures, etc. And we see that India, where we typically are a very, very jewelry and gold economy, is still just 3% of participation in family treasures, whereas China is already 17%, and most European economies range between 7 to 12%, and even Brazil is at 15-16%. So clearly we see the next 5-10 years, 20 years being a much larger participation towards alternatives in general, and collectibles, art, sculptures, and similar collectibles, coin stamps in particular. And that's the space that we guide. We also see a situation where very often families have taken exposure to this asset in the past, but that's not very well managed. And the classic wealth manager in the past has not been able to grapple with the nuances of managing an art collection, which is documenting it, valuing it, ensuring it, restoring it if it is damaged, creating trusts around art. That entire space again is going to need significant attention from wealth managers, from the family offices, which have to either build in-house expertise or more likely partner with other agencies in that space. Other slides, I'll just leave it for later. I'll swing back to the alternate asset side and request Rahul to take it on.
But sorry, Rishi, just to follow up on that, I think the conversation that we all need to have is really around portfolio allocation, right?
Absolutely.
And I think we have on stage different parts of alternatives. And I think in a lot of conversations we've had with families, they typically think of 15 to 20% of their net worth being allocated to alternatives.
Absolutely.
Just give us a better flavor for where does art fit into that? Is that 3% number a number that is aspirational, or is that the current number today in India?
No, very good question. So typically in the alternatives, art or investments for passion are normally around 50% of the bucket of alternatives. So investments for return, which would be private equity, venture capital, would be half, and investments for passion is half.
Right.
And in the investments for passion, art is typically 50 to 75% of that, and the balance investments for passion would be wine funds to other collectibles. So to answer that directly, today at if you look at 20% alternatives, out of that 50% art, investments of passion should be therefore 10% of participation, whereas we are only at 3%. So a long way to go, and generally there's a lot of catch up that is there, right? So this is wealth, not the current cash flows being allocated. So wealth being allocated with this type of catch up, 3 to 17% like China, is a huge amount of backlog, as you can see. So Chinese art market in the last 15 years, to give an example, has grown from a sub 1% of global art market to a 30% of global art market today, and then corrected to 22%. In a $60 billion industry, which is therefore a large industry, to have that type of a swing in allocations is very, very dramatic. So means China, every year, Chinese art is selling 16 to 18 billion dollar worth of Chinese art is selling every year to now reach that type of a percentage. And I think that's the type of potential that alternates have. If you can just look at this slide. So China and US were neck to neck. China was 1/10 of US 10 years back, neck to neck 6 years back, and it overtake US 4 years back. That's the type of catch up that's possible.
Great, thank you. Rahul, would you like to share some of your thoughts around venture debt and how you guys
so ours is not as sexy as art, but we'd like to believe is a nice way to play private credit in India. I don't know if you guys can hear me. So I think broadly, venture debt is a subset of the venture capital asset class. For people who've played in later stage opportunities, there's private equity and there's private debt. In venture so far, there predominantly was venture equity. There wasn't a lot of venture debt. And having been a participant in venture capital since 2005, that was an opportunity that we kept seeing, that many of these high growth asset light companies had raised 5, 10, sometimes 100 million in equity, but banks and traditional lending institutions did not have a framework to understand risk and to appropriately structure a product for the needs of these companies. And that was really the genesis of Trifecta about 2 years ago. Fast forward to last year, which is September, we'd raised about 200 crores, predominantly from financial institutions. Our anchor investor is RBL Bank. They just went public and they've done very well. As of yesterday, I think their stock was up 40%. Yep. So RBL Bank is our anchor investor, which tells you that banks don't understand this, otherwise they do it themselves. So they look to a manager like us and say, we think what you're doing is cutting edge. We don't understand these new business models. We don't understand these companies. Take our money and put it to good use in businesses like this. So around RBL Bank, we've also raised money from development finance institutions, people like SIDBI. Proud to say that we have large insurance companies, folks like HDFC Life as investors in the fund. And then we've had some success with a couple of endowments and large family offices who have looked at us as a hybrid product on the fixed income side and have said that, in the hunt for yield, because I think for many people, they were used to fantastic double-digit returns from debt. I think the new normal is single-digit from fixed income. And so everyone's looking for new product on the fixed income side that allows them to get into, mid-teens returns without taking lots of risk. And that's really the gap we've been able to fill. So at this point, we've now raised cumulatively about 300 crores. We've invested about 100 crores of that in the last 9 or 10 months. Our portfolio is typically companies that have already raised venture capital. And for those of you who would like to participate in the venture ecosystem without taking all the risk of being a direct equity investor, venture debt as a product is quite attractive.
Fantastic. Just along that last point, Rahul, could you also talk about your typical bite size tenor of the loans, just so that the folks in the audience get a better feel for that?
Sure. So, first just at a fund level, we're a 7-year fund, so we're a slightly shorter duration fund. The other thing that's unique about venture debt is we get money back, on a regular basis. So actually we will end up redeploying the capital one more time.
Right.
I think by the time we get to our final close, we'll be somewhere in the 400 to 500 crore range. But that gives us the capacity to do about 1,000 crores of lending over the next 7 years. Typically, the families, that have come into the fund have written anywhere from 10 to 30 crore checks. The institutions have done 15 to 50. But it's a very small set of investors, I think a total number of 15. And we've used no distribution so far. All our capital is being raised by the partners in the fund.
Fantastic.
And so I hope that answers your question.
Yeah. Thank you. Harshad, just moving to you, I know when we were discussing this before the panel, it sounded like you have a very unique model to allow people to get exposure to venture deals.
Sure.
Perhaps you can talk a little bit about that and your engagement with various family offices.
Sure. So I represent the venture side of things, which is mostly equities. Part of our ventures, we are a full spectrum startup investing platform and network. So essentially by full spectrum, I mean we invest in seed, which is very early, $50,000 to $100,000 checks, angel, which is proof of concept companies where you would cut anywhere between $250,000 to $350,000 check, and venture capital, VC level, where it could be a check of around $1 million. So we have a full spectrum of investment opportunities across these. It is almost always equities, and sometimes a convertible note which gets that debt component in, but it is always something that compulsorily converts into equities. What we have done through our ventures is the model of a hybrid platform, which essentially means that we marry the online and the offline world, which is the flavor of the day, especially when it comes to catering to the Indian ecosystem. A pure play online model is something that is not, it does not fancy a lot, especially from the Indian ecosystem perspective. And a pure offline is not efficient. So we have married the two to create our platform. And we've invested around 30 odd companies, around 100 crores till date. It's not a fund, it's a network of investors. So essentially, it's discretionary left to the investors or the family offices to take a decision whether they want to invest or not. And we manage the whole aspect. The point I wanted to really drive today is that how can family offices, just like HNIs, take an exposure into this particular asset class, which again, as Rishi mentioned, has to be a percentage allocation to your overall net worth or your portfolio that you're managing. And the way we put it as that it needs to be a part of your play money, because you're taking a gamble on certain companies which may or may not work out at all. So the mortality rate is definitely there, and hence the approach that one can take is a portfolio approach. You cannot just invest in 2 companies, 3 companies and expect that one of them will become a Flipkart or a Ola. It needs to be, your risk has to be spread across a portfolio of say 10, 15 companies across a period of 2 to 3 years across the market cycles that come in this time duration. Only if you have that approach can you really expect to make returns, because some companies will fail, other companies might just give your capital back, but you'll have those 2 or 3 stellar companies which will give you that expected IRR that you would expect around 25-30% over and above the usual norm of 20% in the public side of things. So this is the approach that I always educate my new angel investors who come on board, wanting to look at this asset class as a serious money-making tool. So it is not something that you would do for passion, like what Rishi mentioned. It is I mean, if somebody says that do you invest in angel as an angel for the passion, for the kick you get, I think they're kidding themselves. I believe that it is a serious money-making machine, and the multiples you can garner through investing in startups could outweigh any other asset class that you may have, including the public equities over the long run. So,
fair enough. So I think we've heard of passion investing, whether it's art, and you gave a few examples of others. I think Rahul talked about how you can get exposure to the venture ecosystem, yet have current cash flows. And then Harshad, you've talked about how a portfolio approach to investing is required if you want to go very early stage. I think from where I come from, the world I come from of private equity, I think the focus is slightly different. At SeaLink, we focus primarily on companies which have proven business models but are now looking for capital and value add to scale up. And so rather than a portfolio approach, we intend on taking a highly concentrated approach, maybe 8 to 10 investments where we'd put in somewhere around 100 crores to 200 crores each. And then get very deeply engaged with them on a variety of different matters, but primarily on also offering some operational value add. The question I have for the panel is around what else can family offices expect apart from just financial returns as they get involved with each of these different asset classes? Because I constantly get that question, especially around either co-invest, so getting exposed directly to the companies, typically because families have experience, networks in a particular domain that they believe that they can bring to the table. Is that something that you guys get? It'll be helpful to hear your views as well. Perhaps, Harshad, you can start on that.
Yes, angel investing is all about, how did the word angel get coined? It is literally somebody coming down from the heaven to give a helping hand when nobody else was around to help.
Right.
So you used to have seed investment where funds were raised from friends and family. And then there was directly the venture capital who said that, where are your numbers? I can't see any numbers, I will not invest. What happens in between? So that's where the angel comes in, where on a POC level, you could cut a check to say that, okay, go ahead and build your dream. But what it means is that as an angel, you need to be involved in a company. There's no doubt about the hand holding that is required as an angel that you need to do for your ventures. So that is an essential thing. Besides that, I think what you can expect from angel ecosystem is definitely, it is no doubt it's glamorous. If you have made a 100x exit through a Oyo or a Uber, that gives you that glamour flavor, but make no mistake that, as I said, the failure rate is so high that you will see a few of your companies die down. So it's a mixture of all of these things. You cannot just let your company, as you said, you need to be involved. Even at your level, you need to be really involved,
yes.
But you are involved as on a fund level for your LPs, because that's whose money you are managing. Here, you are managing your own money. Literally, I am a facilitator. I definitely give you the exposure to these asset classes and these interesting companies. But at the end of the day, you are the one individually sitting on the cap table of the company, and you are responsible in a way for your own, exit. Definitely, we as a platform help you to make sure that happens and handhold you if you are not aware of the asset class. But at the end of the day, you are directly on the cap table yourself. So you need to be much more involved, be it as an HNI or be it as a family office through your wealth managers. But being involved with the company and taking them to the next level is something that comes as part and parcel of investing in this asset class.
Got it.
Yeah, for us, leveraging our investors is an integral part of our strategy. So we have chosen to work with a select set of families which we believe represent best in class in consumer electricals, print media, manufacturing. So we've identified 6 or 7 families. And I can tell you that the reason they came on board, the reason the insurance companies and the banks, et cetera, come on board is largely a treasury allocation. For them, they're looking at a target return, and that's good enough for them. I think as we've gotten families on board, they clearly have a desire to do 3 things. One, they want to learn because they feel like they're stuck in the old economy and they don't have a bridge to the new economy. 2, there's also a generation shift happening where the next generation is not as interested in the legacy family business, and they want to tag along and figure out what we're up to. And 3, the honest truth is that the kind of deal flow that they see through us is not something that is available to them typically. 1, we're not a bank, so we don't go and try and make them do a deal. But 2, because we're already investors in these companies, we have a fantastic amount of information available to us for over an extended period of time. We're privy to their financial performance, we're privy to their financing plans. So, when a company has taken money from us, over the next 12, 18, 24 months, they will raise another round of funding. It could be a large round of funding, could be a small top-up round of funding, but we have access to all of that. And we're already sharing those opportunities with our LPs, wherever we think they're a good fit. Right. So by design, we don't offer up co-invest as a formal product, but I think for both our portfolio companies and for our LPs, it's very much a part of having a relationship.
Interesting. Okay, thanks.
Yes, absolutely.
How about you?
So on the art side, obviously, at the initial level, wealth managers have looked at art as engagement with clients, where we can do a show, bring them together, and sort of entertain them. That's how the whole journey starts. Then now I think there's a greater client pressure because of social pressures, peer pressures, to understand why is, somebody reads in the papers and says, okay, William de Kooning has gone at $300 million, which is close to 2,000 crores. A guy today has gone at 26 crores, 28 crores. What is happening in this scene? I think the next level of expectation from families and clients is, help me understand what is there, why is this such a big sector globally, why are some of these eye-popping numbers visible and I am not understanding that and not participating in that. So I think the next level of initial curiosity and engagement has now got more serious to a level of trying to understand, is there a play for me here? Is there something I could do different and maybe add that extra kick to my portfolio and to my life in terms of aspiration? And therefore the need to understand from a new wealth creation family as to how should I participate in this yard. I think that's a very urgent and immediate need. And then for a family that's already collected art in the past, there is a very immediate need again to get serviced, to get that art valued, to get it insured, to get it conserved, to create trusts around art. As families separate and as succession planning gets more complicated and the value of art or the hidden treasures in the family is getting more discovered, there's a larger need to keep that in the part of the plan. Underlying, I think the message that we're trying to say is that very often as wealth managers or as the family offices are set up generally by people hiring people from wealth management or finance space, the first focus is always only on the traditional assets. That let's try to focus on that because that's more tangible and the client is expecting that from us as a given or as the minimum. I think the expectation has changed already very fast from the client point of view. While the wealth manager is still allocating, only managing the traditional assets, somebody in the family is meeting Harshad in the evening and cutting a $500,000 check into a startup. Somebody is doing a venture debt deal at the side, piggybacking on a private equity relationship as a follow-on or investing in a fund. All of these are or buying high value art. So I think the missing link is that in the asset allocation, this is not being discussed. Traditional assets are being discussed. Which very often the level of value addition, because you're already investing it through mutual funds, debt funds, equity funds, the level of value addition of the gatekeeper, as we say, or the wealth manager or the family office manager is limited. Whereas the family is already exploring deeply in terms of personal aspiration and wealth towards these exotic investments, which are not being mapped in the investment policy frame. So the whole wealth management framework is getting disrupted in that sense by the window that is being watched doesn't need too much to be watched, and what is not being watched is taking much more of the interest and the brain power and the engagement of the HNI. So while Harshad was disagreeing on it's not being an investment of fashion a startup, it's again a fad of its own nature, and the person feels so while that's not as enjoyable as going for an art show or buying art, it's the personal engagement of the person that he wants to be high in everything that he does after a particular amount of threshold of wealth creation. And how do we need to now fit this whole continuum in a manner where this personal engagement still gets mapped in the larger IPS and gets monitored by the family as a whole, while still not stifling the ability to add value by the family patriarch or the next generation. The understanding of a business or personal network is the golden question. That balancing act is something we should all need to strive for.
Come in, that there's a taste aspect that comes in when you invest in art. You need to have a taste for art as obviously as the decision maker, not so much as the wealth manager or the gatekeeper. But when it comes to investing in startups, I can say that it is all about the attitude and the aptitude of investing in startups. It's very different from what is the same for art.
Sure.
So different approaches that you need to take in investing in this asset class. Very new, very, it's not run of the mill, hence the approach has to be different.
You know, one of the discussions that took place earlier, I think it was in the panel before us, they talked about how creation of family offices, not just with the top 100 families in India, but perhaps going all the way down to the 600th family, right? Becoming a lot bit more structured, thinking about where their wealth is being invested, how is it managed, and so on and so forth. All leads you to believe that every one of the asset classes that we are representing today is still in its infancy. And there's a long way to go ahead. Given the audience in the room where you have a mix of you know, families as well as wealth managers, and this is effectively the channel for us to scale these businesses up or scale these asset classes up, perhaps you can share some of your success stories or lessons learned. And Rahul, if I may look to you, given the you know, success you've had fundraising, both from prominent families in India as well as with a lot of institutions. Can you share any thoughts around that?
Sure. You know, look, for us, it was also, you know, a little bit of a journey of experimentation because my prior two funds were large global funds.
Right.
And we'd never raised money in India before. So, you know, I think the first was to, you know, get a good anchor investor. I think the truth is that, you know, without an anchor, you can waste a lot of time, you know, trying to establish credibility and things like that. So I think that also, you know, provided the family offices and other folks a level of comfort that this platform's been diligenced, people have done their homework on it. So step one, I think, was for us to get a high quality anchor. I think post which, it's really about building trust and familiarity around a product. You know, a lot of the initial questions were around the fact that venture debt is a new asset class in the region, we don't have the data. And people who came into the first close, honestly, it was a bet on the manager. So I think my counsel to you is when you're looking at a new product, actually looking at the manager. And you're saying, you know, everything else will change, do I expect this manager to perform? And you have to have conviction and make an informed call, like everything else, that this is the manager I want to back. Because I think for a lot of us, the data doesn't exist on these asset classes, right? So I think given that we're in this early wave of making bets, you'll have to take comfort in one, strong references, and two, your judgment call on whether you like this manager or not. I think now that we're a year into the business, we have a portfolio. I think the other counsel to people is, look, show your strategy working, right? And I think the good news with venture debt is we've built a solid portfolio, companies that many of you will know, whether it's Nephroplus, where we're both involved, or Urban Ladder, or Revigo, or Industry Buying. These are all companies that are now seen as rising stars. And so the strategy of the fund is much easier to understand.
Right.
I think the key thing was to put the right lens on what is the risk reward profile of venture debt. And am I actually taking equity risk and getting debt return, or am I taking debt-like risk and making debt return? And some people got it and others didn't, right? And I think it was sort of binary almost, where if they believe they're taking debt-like risk, then they're very excited about the return. Yep. And so I think, you know, the lessons we've learned is the product must sell itself. I think people will have to take a leap of faith on a manager. I think that you will not always have the data to back emerging sectors. And you'll have to, you know, you'll have to get comfortable that, look, this is within the alternatives investment bucket, and I have to do something different because what worked for the last 10 years is not going to get you there in the next 10 years.
So reputation, trust, credibility, translating into perhaps a proof of concept,
yes,
which, you know, allows them to touch and feel your product, even though it's a push product, and then, you know, that will allow you to scale up,
yes,
is what you're saying. Harshad, I know you've talked about a slightly different approach to perhaps getting the word out through training and other methods. Can you share some more of that?
Right. So this asset class, investing in startups, is something that is very, very nascent in the Indian ecosystem. The way I would suggest, I'll give you a fact. I mean, Canada, let's consider Canada as a country. A population of 40 million odd. Any guesses around how many angels would be there in Canada? Any guess?
No, 10.
8 million angels.
Wow.
8%, no, not 8 million.
20%.
3 million angels. So 8% of Canada is angels. In a country like India, 1.3 billion people, let me not get into percentages at all. I mean, the number of angels are so low. There are barely 500,000 angels in India. That needs, that whole vertical, that bucket needs to increase. And that is what my so-called mission 2030 is, to see at least 1 million angels in India by then. The way I'm going about it is that we need to educate these HNIs or investors in equities who have a decent exposure, say probably a crore or 2 crores in equities, to part with a small percentage of their portfolio allocation towards private equity in early stage, where they can go ahead and cut 2, 3, 5 lakh checks in probably 15 companies and build a portfolio of startups. So that's how we have been trying to promote this whole asset class. But as far as family offices go, and the way we are trying to build them is to talk to the wealth manager there and explain him how they can venture into and how they can move back and explain this asset class to their decision makers. So that is a long run process, and it will take some time. We are today 800 odd investors, hoping to build that to 8,000, 80,000 one day. But as a track record, I can speak for myself. We have invested in 30 companies, as I said, as our ventures, where I have personally invested. Besides that, I have invested in 20 odd companies, a portfolio of almost 50. 8 companies have failed, they have shut down, no doubt about it. There are 8-10 companies which are probably the living dead, as you said. They are just making money for themselves, but I don't think they'll make any money for the investor. But yes, there are 4 odd companies which have given me 50 to 100x, which has covered all my losses. So that approach, as I was saying earlier, is very important on a personal portfolio level or as a platform, educating the importance of having a portfolio approach to things. I mean, there has to be a method to the madness. You cannot just go cut 2 checks and sit back thinking that
expect the 100x.
Expect the 100x, not happening.
Understood. I know I'm getting signals that we've run out of time, and we'd like to open it up for Q&A from the audience. If anyone has any questions, if you can just identify yourselves and let us know who your question is directed to. There's one question right here.
Hi, my name is Sunil Gupta. My question is for Harshad. Harshad, what do you do to acquire the deals from the early stage or seed stage companies? That is one. And second is, how do you curate or do due diligence on these companies to put it in front of angel investors?
Sure, great question. How do I acquire and what kind of a due diligence I do? So acquisition is more of having built the brand so far. In the last 7-8 years that I've built the brand, I get almost 10 companies approach me every day, 15 in fact. So around 300 to 350 companies a month is what approach me.
What is that channel? What is the channel through which you get this? Is it a web channel or platform or word of mouth, or how?
So it's definitely word of mouth. So having done so many deals, we are definitely out there in the market. So they know that they can approach us to raise money. So these could be deals between seed to VC, as I said, right, from $50,000 to $1 million. That's where I invest. That's my sweet spot. Having got so many deals, there has to be a proprietary method that I've built to curate them, because I send out only 6 companies a month to my investors. I'm not a listing platform. I'm a curated platform. So I curate 6 out of the 350 and then send it to my pool of investors for them to look at it. And before, the curation process involves slight amount of due diligence. I cannot deep dive because of lack of time. And unless until I have a threshold commitment, there's no point in doing a deep dive in due diligence. So the 20% due diligence I do to see that everything is hunky-dory, things are the way it should be. And subsequent to raising the threshold commitment, I will go and do a deep dive where my legal team gets involved, my financial team gets involved. They will do a full DD around the company. Due diligence, and is when we actually sign on the dotted line. So it's a properly managed process, professionally managed by various parties involved. And it's not that's not where my role ends. It's subsequently it goes ahead to make sure that until we get an exit, I'm married to the company, because I reinvest my fees into the company. As I was saying, the interests are aligned, be it for the company, for the investor, or for the platform as a whole. Everybody is together for the next 5-7 years, which is what is required for expecting an exit. I hope I answered your question.
My question to Rahul, in terms of venture debt, how different are you from the bank in terms of collateral and the interest rate?
Sure. So, banks operate in a range of 10 to 12%, NBFCs are 18 to 24%. We typically lend in the 15 to 16 band. Our debt is in the form of debentures, so because we're not an NBFC, we invest typically using NCDs. And in some companies where there is hard collateral, we'll take hard collateral. But in most companies, there's just a lot of cash on the balance sheet that's come in because of the recent equity round. So we take a lien on current assets. In many cases, we take a lien on the brand. So many of our portfolio companies, the brand is more valuable than anything else, or the IP in the company. Where there are certain situations where we'd like to align the interests of the promoter more deeply, we might seek a personal guarantee, but that is not the norm for us. So in a lot of ways, we're lending to the company and the liability sits at the company level.
Great. Thank you so much.
Thank you.